According to an Old Mutual survey, in 2012, about 1 in 5 employees with retirement funds considered changing jobs so they could cash in their pension funds. Last year, that number went up to more than 1 in 3, largely due to high debt levels. This is the Moneymakers. I'm Bruce Whitfield. Tonight, I'm joined by Ian Wason, the Chief Executive of DebtBusters, to look at the way that we're getting ourselves into debt. And if we know how we're getting ourselves into it, how are we going to get out of it without having to raid our life savings? Ian Wason, it's good to have you on the Moneymakers this evening. Just give me broad brushstrokes, if you would, on the state of play in terms of South Africans' personal debt levels.
So I think the starting point should be, there was a World Bank report in June 2015 which found that South Africa was the most over-indebted consumer nation in terms of their monthly debt commitments relative to their salary. And I would say it's got considerably worse since then. So things are not going in the right direction. You've got still at least 10 million South African consumers who are more than 3 months in arrears on at least one of their debts. Things are going the wrong way.
If it was so bad, banks would be bankrupt and retailers would be on the skids. Yet share prices of banks, notwithstanding political events, and retailers, notwithstanding the impact of weaker currencies and huge volatility in the economy, they would be bust, but they're not. In fact, they're flourishing. Profits are growing, if not at the sort of heady rates of 5 or 6 years ago, but these are still profitable companies in a profitable environment. They're still making money. There seems to be a disconnect between the consumer experience, the average consumer experience, and the experience of the people extending the debt.
So I think it all depends on how you let the bubble burst. There is undoubtedly a bubble. I mean, let's look at unsecured debt. So in 2008, unsecured debt was 40 billion rand. In 2012, 4 years later, it was 180 billion rand. It has stayed at that level since then. It hasn't decreased, hasn't really increased. It's just been maintaining at that level. What is happening is that banks are tightening up slowly. So they're slowly letting the steam out of this bubble. So it's not a sort of big bang. It's not turning into a massive subprime crisis. But it's just getting tougher and tougher for consumers out there. It's becoming harder and harder for them to borrow. We can see on the statistics produced that the approval rates from all the credit providers is dropping month on month, and that is going to continue. And so what's going to happen is retail sales are going to continue to slow because they can't put more credit onto these consumers. The regulator has tried to do their bit, or the DTI has tried to do their bit by capping interest rates and trying to reduce the costs of the consumer. They've just 2 months ago released the new credit life amendments, which was gazetted, which is going to be a fantastic result for the consumer, because credit life, as we've discussed before, is one of the greatest rip-offs of our time. And they have now capped it at R4.50. I would say that the market price is probably R7.50, with other credit providers charging considerably more. So I think you've got a lot of pain still to come. My concern, if I was running a big bank, would be on the secured assets. It would be on the home loans, and it would be on vehicle finance in particular. And we're starting to see a lot of consumers coming through to us with more and more vehicle finance, and certainly more consumers coming through to us with home loans.
Give me a sense of it there, and let's talk about vehicle finance for a moment, because new car sales have literally fallen off a cliff. They're dramatically slower than they were 2 or 3 years ago. We see only a fraction of the new vehicles being sold. Many of those go into the corporate market, into car hire and into the Uber sales, for example. The South African consumer, my sense is, isn't buying that many new cars. So these people who've taken out the debt in the last 2 or 3 years and have got 2 or 3 years left on their terms, and they're just finding it too tough to pay back on that debt and want to give the keys to someone else. And the debt, of course, the problem.
The vehicle finance companies have been changing their financing options. So, and I stand to be corrected, these are pretty loose figures, that a few years ago, only 1/3 of vehicle finance had balloon payments. And now it's up to 2/3 of consumers who take out vehicle finance have balloon payments. Well, that's not really reflecting the true cost of the debt to the consumer, because you're not exactly taking the 100,000 or 200,000 that they borrow, spread it over 5 years, and the consumer pays it back. Only a portion of it is spread over 5 years, and then you have this big balloon payment at the end. So they've been doing everything possible to keep those vehicle finance numbers as high as possible. Now they're out of options.
Okay, so that's where that particular bubble could burst. What about residential property? I mean, I talk to estate agents all the time, and of course property is a very, very local game, and some areas will do well and others will do badly, depending on the neighbourhood, depending on what people are prepared to pay to live in a particular space. But broadly speaking, are you beginning to see the property market fraying at the edges, or is it only at certain segments in certain areas?
I think probably across the country, property has been flat at best. So I don't think we've seen much growth in there. If you look at the increase in mortgages lent to consumers over the last few years, that's hardly been growing at all. I think it's about 3% a year. Tiny, tiny growth. There are still only about 2 million mortgage holders out there. It was about 2 million 10 years ago. So the number of people with mortgages haven't really grown. It's going to get harder and harder for people to get, or new buyers to get mortgages, because they've taken on this unsecured debt. And it's the unsecured debt that's what's going to kill the people with existing mortgages. You need to take a look at the 2 million consumers who have a residential mortgage and look at how many of them actually have other forms of debt as well, and in particular have unsecured debt, because they are effectively being swapping their secured debt at, let's say, 11% repayments on your mortgage to unsecured debt, which can be anything up to 28%.
Now, I thought we had a National Credit Act and a National Credit Regulator, big policemen of the credit market, and they simply have either been napping, haven't been doing what supposedly their job was, or there's something awfully sinister going on in the credit markets.
I think there are a couple of aspects to that. One is the National Credit Regulator is only as good as the act that they regulate. So they have been slightly hamstrung because of the regulations. Initially, the National Credit Act said that credit providers had to do an affordability test, but it didn't define it. They then tightened that up, tightened the affordability test up about nearly 2 years ago, saying that actually you have to pull a credit report and you have to do income and expenses, etc. But one thing they did do was say that you have to have a minimum of effectively 9% of your expenses must be your minimum expenses on a credit application. Now, I don't know who lives on 9% of their expenses. There aren't many people in South Africa who can live on 9% of their expenses. And what it's done is effectively given unsecured credit providers, the more unscrupulous unsecured credit providers, the ability to lend to consumers up to 91% of their net monthly income in terms of their debt repayments. I think the sustainable level is probably about 40 to 50%. Once you start going over that, you're on a debt spiral.
But it's a regulated industry. Are you suggesting that the regulated players are behaving properly and the damage is being done in the unregulated sector? Or are there regulated players who are getting away with murder?
There are some regulated players who are sailing far too close to the wind and are lending to people who can't reasonably afford to repay. They're lending to people who you and I wouldn't lend to, because we take one look at their income and expenses and their balance sheet and say, you're a bad risk, you can't afford to take on any more debt. But they are still lending to these people, in my opinion, and it doesn't matter how good one credit provider is or the banks. And I'm a firm believer that the big banks have a much process than maybe some of the smaller unsecured credit providers. But it doesn't matter how well the big banks vets their credit risk in these clients. It all matters who comes after them, because they can lend as properly as they can, but whoever they borrow the next loan from, that's where the problems come in.
Do you see the same names creeping up as people come through your doors? Do you see the same credit providers coming up on the bits of paper that are brought into you?
Yes, we do.
And who are the key perpetrators then of this riskier debt?
You're going to try and get me into trouble again.
Well, you know what, Ian? I mean, it's your duty, I think, to expose the baddies for what they are. If you're seeing the same perpetrators come up, what do you do with that information? I mean, do you go to the National Credit Regulator and say ABC Finance, DEF Finance, and JKH Finance are the bad guys here? You really need to clamp down on them, or do you not act on that?
Yes, we certainly do pass all our data through to the regulator, so the regulator is very well informed. The trouble is when you look at these individual cases, the credit provider, and we look at the cases and their assessment, their credit assessment of the clients, and two things have either happened. Either they've said, well, we put in a 9% line for expenses, and the consumer said they can afford it. And therefore, we didn't lend recklessly. So it's not reckless lending. So there's nothing that us as a debt counsellor or the regulator can do. What needs to happen is the National Credit Act needs to change, and they need to tighten up that percentage. And as I said, they need to start working towards reducing that to putting in 50% of their expenses must be accounted for, or 50% of their net monthly income must be accounted for as their expenses. That is the only way to do it. But of course, you have to take small steps towards that, because if you do that in one foul swoop, then half the country won't be able to borrow.
Currently, though, where does that responsibility sit? If there's a means test that has to be carried out, if I said to you, Ian Wason, are you a handsome man? Odds are you're going to tell me in the affirmative that yes, you are. If you say, Ian Wason, are you heavily indebted? You're going to have some level of self-respect, or maybe you're desperate. You'll say, no, I'm not. Both of which, need to be challenged as statements of fact, don't they? And surely it's the responsibility of the credit providers to do so.
Sure, but it's the trouble is in the Act it says that they have to do an assessment. The consumer has to say that they can afford it, and as long as they leave a 9% buffer in for expenses, they can lend the money. So what needs to happen is the Act needs to change, and that falls firmly under the DTI and the DTI Portfolio Committee. And the industry is working with the DTI and the NCR, putting through some new amendments that we want to put into the Act to actually make it harder to lend to people and actually start protecting consumers a bit more. But it's not going to be pretty for retailers and credit providers out there for the next few years if we manage to do that.
Ian Wason, I thank you very much indeed, the Chief Executive of DebtBusters. More ways of trying to dodge the debt bullet next time on the Moneymakers. For now, though, have a very good evening. Good night.